The last commodity supercycle created generational wealth for investors who saw it early. That was iron ore and oil, the fuels of the 20th century. What's building right now looks like it could follow a similar pattern, and most people are completely sleeping on this one. The world needs more copper for every new EV on the road, zinc to protect the steel in every wind turbine, gold when governments panic and print more money, and domestic steel when a nation decides to rebuild itself from the inside out. That's why today I'm giving you 4 stocks sitting right at the center of this global growth trend. Each stock passed a rigorous 115-factor review that has a proven track record of identifying future outperformers. Now, be sure to stick around to the end because the last stock has significant upside potential according to top-rated Wall Street analysts, so you don't want to miss that one. By the way, I'm Steve Reitmeister. I've been investing for over 40 years. I was editor-in-chief of Zacks.com for nearly 2 decades and currently a partner at WallStreetZen.com, where I help develop the quant rating system that allows investors like you to quickly find the best stocks to beat the market. If you like the sound of that, then please hit the like button as it tells me what types of topics I should record more of in the future. Also, a friendly reminder that investing carries risks. This is not personalized investment advice. Always do your own due diligence before buying or selling any stock. All right, before I get to the 4 stocks, it's important to give you some important background on why critical materials are so relevant right now. First, the International Energy Agency's Global Critical Minerals Outlook projects demand will quadruple by 2040 in a net zero scenario. That energy transition is funded, legislated, and already underway. To understand the scale of what's coming, copper may tell you the story the fastest. Like a gasoline car uses about 20 pounds of copper. An EV uses about 180 pounds. A single offshore wind turbine contains roughly 29 tons of copper. A lot of things we use all the time need copper, and that demand is rising fast. The thing is, new mines take decades to permit and build. Not enough are coming online right now. Goldman Sachs titled their 2021 commodities report, "Copper is the New Oil," precisely because of the gap between where demand is heading and where supply realistically can go. That gap is still there, and it may be widening. Zinc follows a similar logic. Galvanizing, or the process of coating steel to prevent rust, consumes roughly 60% of all zinc produced globally. Every piece of infrastructure exposed to the elements requires galvanized steel. With the U.S. Infrastructure Investment and Jobs Act committing $1.2 trillion towards roads, bridges, ports, and grid upgrades, the demand for galvanized steel, and therefore zinc, has a legislative tailwind behind it that will last for years to come. And the domestic steel is seeing something rare, a political protection and genuine demand at the same time. Onshoring, defense spending, power grid upgrades, and AI data center construction. These are the drivers of U.S. steel demand growth in the years to come. What a great dynamic for investments. Surging demand, constrained supply, and decades of underinvestment. Now let's talk about the 4 stocks best positioned to benefit. We're going to kick that list off with Hudbay Minerals with a symbol of HBM. Copper is the metal Goldman Sachs called the new oil, and Hudbay Minerals could be one of the most compelling ways to own that going forward. This diversified miner operates across Canada, Peru, and the United States, producing copper, gold, silver, and zinc, and it has a growth pipeline that looks increasingly well-timed as copper demand projections continue climbing. What makes HBM worth paying attention to isn't just where it's been, it's where it's going. The company just delivered a record-setting quarter with revenue a full $70 million ahead of estimates, leading to a monster earnings beat. Right? So expectations were only for 6 cents per share. Then they shocked everyone by posting 40 cents. Earnings beats like that don't come around often. Those aren't just good numbers. They suggest a business that is executing far, far better than the market expects. Cash costs also fell to a record low of negative $1.8 per pound of copper, meaning byproduct credits from gold and other metals are essentially paying for the full copper production. The company now sits on over $1 billion in cash with net debt essentially at zero. This gives it a significant financial flexibility heading into what could be a multi-year copper upcycle. And the most forward-looking piece, the Copper World Project in Arizona, and the most forward-looking piece of this investment story. The Copper World Project in Arizona is advancing towards a final investment decision later in 2026, with production targeted for mid-2029. This could potentially bring new domestic supply online, just as the copper deficit could be deepening. While coverage on the stock is limited, all 3 analysts tracked by WallStreetZen covering HBM currently rate as a strong buy. Now, Limited coverage isn't necessarily a bad thing. It could be a positive sign that you've unearthed a ticker that is flying under the radar. The Zen rating system is optimistic on the stock as well. HBM currently receives a B rating, which amounts to a buy recommendation. Each Zen rating is the result of a full 115-factor fundamental check, organized into 7 key component categories, which they received their own grades. HBM's standout component grades are above average B grades for both momentum and financials. Normally, mining companies score very poorly for financials because mounds of debt. Okay, that's not the case here, which gives them lots of flexibility to fund growth going forward. A real risk worth considering is copper production in Peru declined quarter over quarter as higher grade ore was depleted and cost pressures from fuel prices and labor are emerging. That said, with record earnings, $1 billion in cash, strong Zen ratings profile, a major new copper project advancing towards a sanctioning, and what looks like a very favorable copper price environment, well, HBM could be worth a serious look for anyone wanting a direct exposure to the metal at the center of the energy transition. All right, let's move on to the second stock in Nucor Corporation with a symbol NUE. If steel sounds boring as a critical minerals play, then consider what steel actually touches right now. EV manufacturing plants, AI data centers, grid infrastructure, defense build-outs, and American manufacturing onshoring. That is a wide slate of things leading to increased steel demand. As you likely know, Nucor is the largest steel producer in the United States by capacity. It could be one of the most direct ways to own the domestic industrial renaissance without taking on the commodity speculation risk of a smaller miner. What makes Nucor's setup interesting going forward is the convergence of tailwinds that don't appear to be fading. Trade protection is keeping foreign steel out of the U.S. market. Domestic demand is being driven by infrastructure spending, reshoring, defense, and AI build-out simultaneously, and the company is executing brilliantly. The proof of this is on full display with their first quarter 2026 earnings report, which showed profits 4 times higher than the year before. Yeah, 4 times higher. And yet, the forward PE sits at only 13.65, which is very modest given the earnings trajectory and the structural demand picture ahead. And it's also worth noting that the dividend has grown for 10 consecutive years at a payout ratio of just 22%, meaning substantial room to keep growing it from here. Right now, Wall Street analysts are on board with a lot of SPY and strong buy recommendations. Notably, there are no sell or strong sells on the books. The Zen rating system is similarly bullish. NUE receives an overall A rating because it's in the top 3% of all stocks reviewed. The component grades reveal balanced strength with several above average B grades. That includes a top 17% showing for financials, top 15% of all stocks for growth, and top 6% for momentum. Now, financials and growth are the 2 best predictors of future earnings beats, and high marks for momentum points out that shares are timely at this time. Now, one risk worth flagging, steel is cyclical, and a slowdown in construction or manufacturing activity could pressure volumes and pricing quickly. That said, with multiple structural demand drivers converging at once for steel, tariff protection in place, and a balance sheet built to weather downturns, Nucor could be worth serious consideration as the domestic build-out continues to accelerate. Before we move on, if you made it this far, then chances are you're getting something out of this video, and you might like to see my future recordings. So if that's the case, the best thing you can do right now is to subscribe and hit that notification bell. Now let's move on with the third stock in SSR Mining with a symbol of SSRM. Gold is often overlooked metal in critical minerals conversation, but it probably shouldn't be, and here's why. Because central banks are buying gold at the highest rate since the 1950s, and when that's the case, gold prices tend to behave less like a commodity and more like necessary insurance. SSR Mining could be one of the most interesting ways to own that insurance right now, not because it's a household name, but because it's in the middle of a transformation that could make it a fundamentally stronger business going forward. The headline strategic move is the company announced a $1.5 billion sale of its copper mine in Turkey, expected to close by the end of the Q3 of 2026. This repositions the company as a pure-play, Americas-focused precious metals producer. The sale alone could add roughly $1.5 billion in cash to a company currently valued at around $6.3 billion. A meaningful balance sheet event. The earnings picture is already strong thanks to the recent 46% beat, and yet the stock trades at just 7 times forward earnings, which looks modest for a gold producer with a major cash infusion potentially on the way. The Wall Street analyst coverage is small but mighty. One rates it a strong buy, the other rates it as a buy. Even better, is the fair value price targets, pointing to over 50% upside in the year ahead. The Zen rating system is in alignment with Wall Street's best and brightest. That's because SSRM receives an A rating, which amounts to a strong buy recommendation. Its component grades are impressive as well, with financials, growth, and momentum ranking the top 20% of all stocks tracked in the database. However, the best grade is the A for value, ranking the top 4% of all stocks. There are no shortage of attractive gold miners to consider. However, SSRM is on the verge of a transformative cash event with the sale of the copper mine that could greatly improve the trajectory of shares in the months and years ahead. Before I get to the last stock, I want to invite you to join me for a live training session this coming Monday at 7 p.m. Eastern Time. That's when I share my updated market outlook, plus my trading plan to beat the market, as well as the top 7 stocks for the week ahead. In these live training sessions, you truly get the best of the Zen ratings and my greater than 40 years of investing experience. So be sure to join me this coming Monday at 7 p.m. Eastern Time. It's totally free. Just sign up at WallStreetZen.com/live. You'll also find a link in the description or scan the QR code on the screen. Forward to seeing you on Monday. Let's close out the list with Nexa Resources with the symbol of NEXA. If there's one stock in this video that potentially captures the entire critical minerals thesis in a single ticker, then we're talking about Nexa. This Latin American polymetallic miner operates 5 mines across Peru and Brazil, producing zinc, copper, silver, lead, and gold, right? That's not diversification for the sake of it. Those are precisely the metals that the energy transition and infrastructure build-out depend on. What's driving Nexa isn't financial engineering, it's commodity prices, and Nexa produces nearly all the metals benefiting from the current upcycle. Copper rose 38% year over year through the first quarter of this year. Zinc gained 14%, silver and gold surged 157% and 69% respectively. Nexa captures all of it across 5 producing mines. The recent quarterly earnings results reflect that exposure, with revenue up 42% year over year. This led to a greater than doubling of EBITDA. Once again, we see ample growth, but surprisingly low valuations. In this case, we have a forward PE of just under 6, which seems obscenely low given their impressive earnings trajectory. Now, the Zen Ratings model appreciates what is special about Nexa with an elite A rating, which amounts again to a strong buy recommendation. Impressively, it shines with 3 component grades in A territory: growth, value, and momentum. Truly, this is a trifecta of ratings, as too often growth stocks are overpriced or value stocks are not timely. In this case, we have all 3 in our favor. One real risk worth considering: Nexa operates in Peru and Brazil, where political shifts and community relations have already caused some temporary production disruptions this year alone. That said, with 5 producing mines giving them exposure to nearly every metal in the current demand upcycle, and a valuation that hasn't fully caught up with the fundamentals, Nexa remains a compelling stock to potentially add to your portfolio. Now it's your turn to sound off. Which of these 4 stocks are your favorite and why? Or did I miss a ticker that's on your radar? Let me know in the comments section below. And if you want to explore another emerging market trend, then be sure to check out my video about the quantum computing revolution.